Hello everyone and welcome to your Glassnode video report for week 43, 2022. So we are sitting here in this very tight price range, and as we mentioned last week, Bitcoin does not sit tight for very long. The probability of a high volatility future is starting to grow, and what we wanted to present today is a bit of a bull and a bear case, because the reality is nobody knows the future. What we're going to try and do is look at all the data that's at our disposal and try and establish what is a likely scenario. What are the key metrics to pay attention to for it to move in either direction? So a bit of a gauge on both the bull and the bear side of the equation. So as I mentioned, we're going to be looking at those two arguments, and we're going to be covering 4 different topics, 2 in each. The first one is the on-chain activity, which remains extremely weak. So we're looking at that as a bit of a view into the demand profile for BTC. We're then going to look at the risk of a minor capitulation, which is growing as the cost of production increases, difficulty winds up, hash rate pushes to all-time high. The probability that miners are now under extreme income stress is growing, and thus they may need to liquidate larger portions of their treasury. Now, on the bull side, we still see exchange balances declining. Now, exchange balance is one of these things that can't be looked at in isolation, but we will look at it within the context of what's going on the investor wallets. Where are those coins going when they flow out of exchanges, and what's the character of that accumulation profile? And we're going to close out looking at the HODLers, who, despite all of the chaos of the last 24 months, a vast majority of these holders just simply do not care. Their coins are quite clearly showing an extreme level of HODLing. In fact, we are essentially at all-time high wealth concentration within the HODLer cohort. So we're going to look at this from a few different angles. And really what we're looking for here is the most objective view that we can from both a bearish and a bullish case using all the data that's at our disposal. So let's get started. So starting off with our price action, what we can see is that we have essentially gone to sleep. Bitcoin has become a stablecoin down here at 19,300. Very rarely do we sit here for a very long time. And as I mentioned in previous videos, there are 2 instances that I have seen in the where Bitcoin has basically gone to sleep like this. One was November 2018, followed by a 50% sell-off. And the other one was April 2019, where we went from 4K to 14K. Which is why we've tried to provide a bull and a bear case, because really this is trying to give a view on what could happen in these different scenarios, because reality is either could happen. So here we are starting with the bear case of Bitcoin. So we're going to look at the on-chain activity profile. I'm a huge fan. This is my new favorite metric. You've probably seen me use this, and this is actually metric of the week. So I strongly recommend everybody with a free Glassnode account will have access to this. This is one of our workbench creations called New Address Momentum. So what we're looking at here is the number of new addresses on chain. So we're looking at overall on-chain activity and the very simple framework. The more people using Bitcoin, the better it is, right? And vice versa. So the red curve is showing the monthly moving average of new addresses. And as you can see, during more bullish markets, as you would expect, it tends to trend higher. During bearish markets, it tends to trend lower. Now, the blue curve is our yearly moving average. So we're essentially looking at a fast, slow moving average pair. Now, very simply, when the monthly is breaking above the yearly and stays above it, it's generally a good sign. We typically stick within a somewhat bullish trend for that period of time. And note this great crossover that happened before the sell-off back here in May 2021. Right? So we got a leading indicator that the monthly was starting to decay faster than the yearly, and we actually had a declining degree of network effects, which is a leading indicator. You combine that with a series of other things, and you can start to say, well, maybe there's a bit of weakness in this trend as we've just come off the all-time high. So what we can see is that we have had a few attempts. The November and October, we did not get above. Back here at the all-time high, we did not break above. It was rejected. It was rejected again just before Lunar imploded, and then again as we had this major sell-off. And here we are butting up against that yearly once again. So a nice break above that would be a good sign, but right now you can see it's got a little bit of a curl. So we're just not there yet. And thus it's basically saying that over the last month, we have less on-chain activity than our yearly, and thus it falls into the bear camp. And you can see back here, I mentioned that November 2018, we had the exact same effect that was rejected. And then back here in January 2019, much the same way that this was an early signal for us losing our actual all-time high and breaking into a bear market. here was a very, very early signal after we bottomed. In fact, it looks much the same as where we were before. We had that successful break above, and that set us up for a period, from 3,000 all the way up to 69,000 over a multi-year time frame. So this is the metric that I'm paying attention to. If you're looking for a alert idea, a 30-day moving average of new addresses getting above 410,000 would be that first sign that we're up above the yearly. And this is one that I would be paying attention to. So keep that in your back pocket. Now, very similar, looking at the number of non-zero addresses. Again, we're looking at network effects. This is big picture. But what we've constructed here is the number of non-zero addresses in orange at the back here, which you can see generally trends higher except during major purge events where we have these basically a big purging or a flushing out of wallets. And what I care about here is the gradient. Steep gradients show a lot of people coming in. Flat gradients or negative gradients show essentially a stagnation. And you can see that we've hit a period of stagnation since really September onwards, or August even. We've seen a bit of a stagnation. And this oscillator that you can see is showing the percent growth or decline in red. And what you can see is that much the same as price, it's gone to sleep. So if we think about that, Bitcoin is currently consolidating here at 19,300. It's become a stable coin. The rest of the world is blowing up on a macroeconomic framework. Bitcoin is basically going sideways, and we still do not have more people coming in. We've talked about this for many months now. Essentially, this describes a market where there are no reinforcements, only the hodlers remain. There is basically no growth going on anywhere in terms of new people coming in. So it's essentially hodlers holding the line, and that's more or less all we have. So in terms of a bear case, the hodlers so far have been unable to hold 30K, 40K, 20K, 19K. Like, we are currently down at these levels because there simply isn't the influx of demand coming in. So really, when we're looking at who's left, it's just the hodlers. And thus we have to put this into the bear camp. Really what we want to see is this thing really start to accelerate and rip higher. A flush out to the downside would be even worse. And that's why we have an alert idea here. If we got down below 42.6 million total addresses, that would start to signal we may actually have a purging of wallets rather than a growth of network effects, which wouldn't be a great sign. And when we look at transfer volume, we're looking at our change adjusted transfer volume here. I mean, if you just look at this chart from afar, this looks a little bit sad, right? We've essentially collapsed not quite to cycle lows. We had lower values here in July and June 2021, but we are clearly at the very, very bottom range. We're below where we were back here in 2017. It really goes to show that there's just simply not that much going on chain. And, realistically, that's giving us a view into the demand profile. So the network has low utilization, network effects are not growing, and all of these things really should be interpreted as a bear case. Now, just for a very, very slight glimmer of hope, right? All of these are very big picture. You can see we're looking at multi-year timeframes here. In a much more zoomed in view, I'm looking at the mempool here. So these are actually transactions hitting our node here at Glassnode, and very, very high level. Sometimes it's nice to just look at these metrics and just see what stands out. And as you can see, through all of this bearish trend, you can see that this has a particular character, very, very spiky, bouncing all over the place. Look what happened in September. Something changed, and the market is there's a few more coins hitting our mempool. In terms of the overall transactions, there's a little bit more of a sustained push higher as the market consolidates in a very flat sense. Now, this is not saying that a reversal is imminent. This is just something that looks like a change of character. And when I see things like this, what that tells me is just pay that little bit more attention over coming weeks, because something appears to be changing. It could be a flash in the pan. It could just reverse back to nothing. It could be just another piece of daily noise. But this has now been going on since really September and through most of October. There's just something different about the amount of activity, the behavior patterns on chain. So thus, it's time to just pay a little bit more attention, kind of aligned with our new address momentum. We're butting up against the yearly, so something's about to happen. It's time to be just paying that extra bit of attention, because whatever happens from here, it could very well confirm that this is actually a good trend, or it could in fact be people are distributing and exiting. We're seeing something change in the mempool. So just something to just be aware of and paying attention to. So in terms of a catalyst, generally to break out of a range where we're trading sideways for such a long time, there's normally a story. Now, we can look at the data, we can look at all the volatility, and we can say, well, it doesn't really matter what the story is. It's going to be something that triggers this, right? And then financial media will start assigning all of that. Oh, look, it was this minor capitulation that caused Bitcoin to go down. It's like, well, Bitcoin's going to move no matter what we do. It never just sits tight like this forever. This is the same for any asset in any market. But when we look at the Bitcoin mining space, it's increasingly probable that this is going to be, at the very least, part of that story. So what we've seen is hash rate pushed to all-time highs. We talked about this, I think it was in week 40, a couple of weeks back. We've seen hash rate pushed to all-time highs, difficulty go to all-time high. And what that means is that the cost of production for BTC keeps climbing. Now, this is likely because there's a series of Bitcoin mining rigs that were purchased back in 2021. It was easier credit, easier money. And what we were basically seeing is that there was supply chain disruption. They literally could not produce, ship, and deliver those ASIC rigs. Well, now they're arriving and the revenue is at all-time lows. We'll touch on that in a second. So all these new rigs that have already been bought and paid for, that CapEx has already been spent, arrive. What are you going to do? You've got to switch them on and just start mining. Get as much money out of them as you possibly can until they essentially hit their OPEX cap. So what we've seen is that the cost of production is now equal to price, 19,300. So we are now in the territory where Bitcoin miners are highly probable to be stressed. Now, the last time we had a crossover, right back here in 2014, and then again here in 2018, it was mid-bear market, not late-stage bear market, mid. Now, this doesn't mean that we have to be mid-bear market. This is an estimate model. It's trying to capture the all-in price. What this really matters is, are miners under stress? So that's really what we're seeing here. And what we saw following that period is, yes, they were, and we saw large amounts of coin distribution by miners. So we are essentially at break-even point right now for the average miner. That means that anyone who's not an average or better miner in terms of their balance sheet control is currently under severe stress. The probability of a mining capitulation is massively increased at this point in time. And to just hammer home that point, this is now miner revenue per exahash. You may hear this referred to as the hash price. Essentially, how much income do you earn per hash you put onto the network? So when we look at it on a per exahash basis, it's about 260 exahash online, if I'm not mistaken. It's about 66,500, which is the all-time low. I'm just going to zoom out here so you can see the whole history. Hash price keeps going down because the block reward in orange is always going down. And even though price goes up, the amount of hash power fighting over those remaining coins goes up and up and up as well. So essentially, the competition for BTC right now for hash power is the highest it's ever been. The revenue per hash is currently the lowest it's ever been, and thus we have a perfect setup for miners to be in extreme income stress. So the next one I want to look at, this is just a very interesting metric, but it sets us up for the next one. What we're looking at here, we've used miner revenue to estimate hash rate. So at Glassnode, we do a lot of labeling. We're actually trying to look for exchanges and miners and different entities on chain and assign labels to them. Now, the yellow curve here is all of the miners, the hash rate that we estimate is assigned to what we call other, or these are unlabeled miners. Now, back in the very early days of Bitcoin, with the exception of Satoshi, who we can identify via other means, it's very, very hard to know who was mining on a laptop back in 2011. So back here, almost 100% of all of the hash rate was attributed to what we call other, unlabeled miners. But as you can see, through history and time, we've been able to obtain more and more information until where we are in 2020 onwards, with the exception of during the Great Miner Migration, when there was a lot of shuffling going on, a lot of mining hash power coming off and on, a bunch of people with S9 rigs in their basement were able to flick them back on and be profitable. But for the most part, since 2020 onwards, note that we're essentially capturing, there's almost 0%, it's about 95% plus we have labeled in orange, in red. So the amount of miners that we're tracking, that we're aware of and actually tracking their balance from March 2020 onwards is somewhere on the order of about 95 plus percent. So what does that mean? Why is that important? Well, when we look at the miner balance, what I'm doing here is I'm removing Satoshi, right? Because we don't care about Satoshi at this point. And I'm removing all those unlabeled miners. And the reason I do this is because it's slightly cleaner data. What we're looking at is of the miners that we are aware of that are in fact participating in the hash rate at the moment. This essentially, this balance change here in orange accounts for 95% of the hash power. So we're capturing the vast majority of the impact, and thus when those coins are sold, bought, accumulated, it's giving us a reasonable idea about what's actually going on. So the reason I'm looking at this particular metric is now that we've established that miners are under stress, and we're going to look at the miners who are active right now, which is 95% plus of them, how much coin do they have in their treasuries that they may liquidate? That's the important question. If a miner capitulation is to happen, what's the actual risk? And what we can see here, this is about 78,200 BTC. Now, at current prices, that's about $1.5 billion. So we talked before about a catalyst, $1.5 billion. It's unlikely that they would market sell the whole lot, but it gives us a bit of a range for what is the scale of this problem. And when we think about that, 78,000 coins. Luna back at 30,000 was flushing out about 80,000 BTC. We saw a huge deleveraging event at that time. So it's essentially looking at an equivalent sum of coins, granted at a 50% cheaper price, but an equivalent sum of coins being flooded onto the market. And the risk here is that, as we saw with the on-chain activity space, it's pretty light. We saw last week that the order books are pretty thin. Trading volume is pretty much back to December 2020 levels. So what the real risk here is a huge sale into very thin books. Basically a deleveraging, a forced selling at a period of time when the market is the weakest and least able to handle it. That's really what the bear case is based on these two particular views. So again, it doesn't mean that 1.5 billion is going to hit the order books tomorrow, but it gives us a chance to quantify and understand what is the risk should that happen. And given the miners on basically at all-time low revenue, it becomes increasingly probable that at least some portion of these coins will come into the market. And just note, it actually started going sideways from accumulation to sideways as we got to 30,000, 40,000. So if we're now down at 19,000, this change in behavior is now likely to actually shift in the other direction, where it becomes a sale, a pure distribution. They started selling all their coins and stopped accumulating at 30,000. So once we get down to 19,000 and cost of production keeps going up, it's, the risk increases. Right, so that's enough doom and gloom for one video. Let's move on and look at the bull case of Bitcoin. And what I'm looking at here is really focus on the HODLer cohort, the accumulation behavior, and what's going on with exchanges. We're looking at the supply and demand balance, and just trying to identify two things. What's the magnitude of it? And what's the behavior patterns? This is where on-chain analysis is super powerful. You are looking for behavioral changes. When did the market shift their behavior? Much the same as miners changed at 30,000, 40,000. We're looking for a change in behavior down here at 19. So the first one is our trend accumulation score by wallet cohort. Now, what I see here in October is something changed. Price went sideways. So price didn't change, right? We know price is exactly the same as it was at the start of this month. But note how these move from a yellow or a red, which is distribution. Red is distribution. Balance is actually declining. Yellow is basically neutral, no change. Blue is balance is increasing. So what I'm seeing here is that as price goes sideways at the bottom of our price range, that's important, keep that in mind, there's been a behavioral shift in pretty much all wallet cohorts. The big whales up here at 10,000 plus, they still are distributing, but it's getting a little bit lighter. They definitely distributed into the rally, and it's starting to soften. Everyone from 10K BTC down to, down to 10 BTC, so arguably the vast majority of wallets, are essentially in accumulation mode right now. It's soft, but it's a behavioral shift. There's something that changed here in October. Down here at 1 to 10, that's been pretty constant for the whole period. And even retail, after being somewhat less than 1 BTC wallets, somewhat neutral, have moved back into a slightly heavier accumulation. People are feeling a little bit more confident down here in October because price is holding, volatility is low, the rest of the world is in complete chaos, and Bitcoin has become a stablecoin. So there's a slight change going on in that behavioral shift. And note that I mentioned at the bottom of the price range, that to me indicates that because we have hodlers primarily in this market, the probability is that they know to wait. They're patient, right? They're long-term holders. So what I see is long-term holders up above 30K I mean, these guys are underwater by such a margin that they just simply don't care. And again, I've got UTXOs myself up here at 50,000, 60,000, 40,000, and I just don't really think about them, right? It's not really part of my day-to-day thought process. And likewise for coins from the previous cycle. These guys are pretty much unaffected by price. They are a price-insensitive cohort, and there's a huge proportion of supply held by these guys that just isn't going anywhere. Now, at the bottom of the range, what we see this nice big triangle? This looks like increasing support with lower prices. This looks like patient buyers, patient accumulators who are adding, as you can see, a very, very, very large sum to their balance at the bottom of the range. This looks like accumulation. Now, some of you who've been watching these videos for some time will remember way back in April 2021 and then again in November and October 2021, we talked about the URPD, this metric, but in a top-heavy manner. What does that mean? That means that up here, it was the exact opposite chart. When we're at the all-time high at 60,000, we had all of these coins up here at 60,000 and basically nothing below it. This looks like the exact opposite. It's a mirror image. We are very bottom-heavy. And that's quite literally the opposite. It's showing that we actually have support down here. Now, the risk, because there's always risk, is that there is an air gap. Very little supply has changed hands between 18K and 12K. Now, that doesn't mean that we have to fill in the gap down to 12K, but what it does mean is that it's almost price discovery. There's very, very few cost bases down there. Few people stepped in and actually bought and sold at that price. It's essentially an air gap. So we may and are likely to see some kind of volatility should we trade down below that 18K level. Just as a bit of, these things can always go both ways. So just being aware there is an air gap down below us. Now, looking onto the exchange side of the equation, what we can see here, this is our percent balance on exchanges. And I mean, this thing is just in a relentless downtrend, has been since March 2020, which was the all-time high. Massive downtrend. We're down at 12.2% of supply. This essentially has reversed every coin that's ever flowed into exchanges that we track since the all-time high. I mean, not quite, but January 2018. Since then, has now been fully withdrawn at prices. Back here, it was flowing in at, sub 20K. Most of these have been flowing out from above 20K. So we have seen an extraordinary amount of long-term supply demand. Now, what we can see here, this is the balance on Coinbase specifically. Now, we saw about 42,000 BTC downtick this week. Now, these coins are going into some kind of both combination of investor wallets, but also institutional grade custody setups. They're not wallets that are associated with any exchange that we can identify. They're essentially getting pulled out and put into some kind of custody arrangement. So 42,000 BTC is a fairly decent chunk of change. And we were talking about miners before, their entire balance is 78,000. So, more than 50% was taken out in a single set of transactions here. So there is, you can see this kind of massive stair-stepping pattern for Coinbase. These coins are going into some kind of institutional grade custody alongside investor wallets. So there is that demand there. It's just coming in more and more sporadically, right? So it does show that demand profile continues to exist in exchange balances. Whilst it's not a signal by itself, it must be contextualized. What we're doing here is providing that context. So the next one I want to look at, this is a really cool metric. We rolled this out recently. This is one of our Workbench presets. I would recommend checking out our stablecoin presets on Workbench. There's a whole bunch of cool stuff that we've just rolled out. This one here is a two-part model. It's called the exchange buying power. And what we're looking at in orange, I've combined the USD value of BTC and ETH flowing into exchanges. So think about that as selling pressure. BTC plus ETH combined, the two majors, how much USD value is going into exchanges. If over the last month, there's more going in than out, this will turn orange. Now, as you can see, we've turned from orange, this was distribution, which you can see here did not break down below the lows. And we are now in a period of there's more coin coming out of exchanges because there's no orange bars here. So that's step one. There's more BTC and ETH flowing out than in over the last month. Now, once we look at that, we've also got stable coins flowing in and out. Now, if this is green, it means that whatever was flowing in for BTC and ETH, stable coins were flowing at a much higher rate. So what we're seeing here is that there was about 3 billion per month flowing in of stable coins at the same time as more coins are flowing out for BTC and ETH. So there's more stablecoin buying power on exchanges relative to the two majors. So it's a bit of a combination model. It's trying to look at just the general flow of funds, giving you a big picture macro view. But the take home here is that BTC and ETH are flowing out and stablecoins are flowing in. That's the current setup that we have at the moment, which alongside we can see that exchange balances keep coming down. There is some accumulation going on. It's starting to build up a bit of a cohesive story. Now, the last thing I want to touch on is the HODLer cohort, because obviously those coins can flow out of exchanges all they want. But do we have all the folks who continue to hold them? Are they still of high conviction, or are they starting to panic and go, oh, maybe I need to get out of this thing? Well, if we look at the realized cap HODL waves, these hot colors down the bottom here are coins younger than 3 months. We are at all-time low. 11.5% of the USD wealth invested in Bitcoin is held by young coins, which means that the all-time high of coins held by old hands. We essentially have the largest HODLer cohort on a per supply basis that we have ever seen, which is quite remarkable. Considering how savage this bear market has been, the HODLers simply don't care. These massive downtrends that we see in realized cap HODL waves is essentially a sign that HODLing is happening, and they are high conviction and they're just simply not spending. We can confirm that with Liveliness. So Liveliness will trend higher when HODLers are spending their coins. The steeper it is, the more they're spending, and it will trend down when they're accumulating and HODLing, and steeper. Look how steep this is. We're starting to get an acceleration of that HODLing going on. And this binary oscillator down the bottom here is pretty much at all-time lows. This will signal when there is absolutely no spending going on. The lower it is, the less spending. And essentially, HODLers do not care. It aligns with our URPD metric. It aligns with our realized cap HODL waves. All of these metrics are telling you that this is essentially a long-term HODL. People are essentially just stacking sats and putting them away into cold storage. There may not be many HODLers left. They may not be using the network to a great extent. However, they continue to chip away and pull those coins out of exchanges. This kind of long-term dynamic thing. It takes a long time to play out. This is why bear markets are not over in a week. But what we are seeing is that their conviction remains unchanged. And the very last piece of evidence I want to provide for this is our long-term HODL supply. Now, I do a bit of magic here. The orange curve is our long-term HODL supply. Just the base metric, 13.8 million coins. It's about 72% of the supply is held by long-term holders. Now, that threshold to become a long-term holder is 155 days. So I have shifted it back 155 days to create the blue curve. And what this is showing us is when we actually have, where do those coins get accumulated in the first place? Now, what this is basically showing us is that these coins were accumulated. We can see this massive uplift in our long-term holder supply. These coins were accumulated during Luna as it was selling off. So what we are seeing is that those coins held by long-term holders, they were acquired when the market was capitulating 50% down and they didn't spend. It's showing you that conviction. They literally bought the dip as Luna was imploding and the world was deleveraging, and they simply did not care. So it gives you a bit of context for just how high the conviction of these hodlers really is. It is quite remarkable. And what we see here is a fairly high conviction hodler set that they don't seem to be going anywhere. So thanks for tuning in for that, folks. Hopefully you found that useful. The bull and the bear case, it's important to look at both sides. It's giving us a bit of a view on what could and should and may be happening. What I would suggest is pay attention to this new address momentum, because that's going to give you both signals in both directions. You'll find that in the description below, and I'll see you in the next video. Cheers.